This is your technical update from the LMAX Exchange Research and Analytics Desk for Wednesday, April 13th, 2016. Euro dollar. So the euro continues to remain pressured to the downside despite its recent break to fresh 2016 highs. It seems every time the market trades to another 2016 high over the past several days, it's very well capped into that rally in favor of a renewed downside. But again, there's some key support that comes into play at 113.27, and so we're going to need to see a break below 13.27 and a close below that level to confirm some form of a short-term top at a minimum ahead of fresh downside. Inability to take out 13.27 will keep the pressure on the top side and open the door and suggest the possibility for fresh upside to another fresh 2016 high beyond 114.65 and towards 115 further up. It is worth, however, noting that there is significant medium-term resistance into the 115 area, which could be capping this latest euro rally. Sterling dollar. So cable continues to trade within a broader downtrend, and despite this latest correction over the past few sessions, the market is expected to once again find a lower top ahead of the next downside extension below 140 and back towards the recent 7-year low at 138.36 further down. At this point, any rally should be well capped with only a break back above 145.15 to compromise the bearish outlook for sterling dollar. Dollar yen. So dollar yen has shown some potential for a rebound over the past couple of sessions, with the market closing higher on Tuesday, ending a sequence of 9 consecutive daily lower tops, which could open the door for fresh upside correction in the sessions ahead towards some previous support now turn resistance at 110.67. At this point, though, overall, the downtrend still remains intact following the breakdown below 110 the other week, and does suggest that a lower top should be sought out ahead of the next downside extension towards a key measured move objective at 106.50. Ultimately, only back above 114.87 would really compromise the overall bearish structure in dollar yen. Euro Swiss. So Euro Swiss hasn't really done much in recent trade, though the market has gravitated back towards some key support in the 108 area. At this point, though, the market would need to establish below 108 to take the pressure off the top side, with an eventual break back above 110.24 favored to open the door for a retest of the multi-month peak at 112 further up. Again, only below 108 would really compromise this outlook. Aussie dollar. So Aussie continues to be very well bid on dips, with the market trading back towards its recent 2016 peak from the other week at 77.23. A break and close above 77.23 would expose next medium-term resistance at 78.50 further up. However, inability to establish a close above 77.23 could suggest the market is looking to top out, but we will need to see a break back below 74.77 to strengthen this outlook and accelerate declines. Dollar CAD. So dollar CAD has seen some setbacks extend to fresh 2016 lows in recent trade, with the market taking out the previous base at 128.58 and also the October base at 128.32 to trade into the 127s thus far. This does potentially open the door for the next downside extension towards a measured move at 125, but given the pullbacks, the intense pullbacks that we've seen since January, additional setbacks should really be limited in favor of some form of a bullish resumption. But overall, the market's going to need to establish back above 132.17 to really take the pressure off the downside. Kiwi dollar. So Kiwi has rallied back up above 69 and now trades just shy of that 69.67 2016 peak from the other week. But overall, just like with Aussie, the market continues to be very well capped on a medium-term basis into rallies, with the 70 handle here seen as a formidable cap ahead of what should be a resumption of declines. Really, only above 70 would suggest that the market is looking for a more meaningful shift in the structure, and again, topside failures are expected ahead of 70, ahead of the next major downside extension. But we would need to see a breakback below recent support at 67.59 to really confirm the resumption of declines and accelerate. SPX 500. So the S&P 500 has stalled out in recent rally off that 2016 low, that 1808 from February, and the market has traded all the way up to 2080 before stalling out. But again, there are signs, despite this latest recovery over the past couple of sessions, that the market is looking to maybe carve a meaningful lower top below the 2015 record high ahead of the next major downside extension. So while the market holds below 2100, ideally below 2100, there is risk for the formation of this lower top ahead of the next major downside extension below 1808 and potentially towards the 1500 area further down. At this point, a breakback below 2021, however, would be required to strengthen this outlook and accelerate the declines. Gold. So gold overall continues to be very well supported on dips, and the market is favored now to trade higher, back above the recent 2016 peak at 1283, 1284, and towards the 2015 peak from January of 2015 at 1307 further up. Ultimately, any setback should be very well supported down towards previous resistance now turned support in the 1190 area, with only a breakback below 1190 to compromise this newly adopted constructive outlook for gold.